Hey everyone, welcome to my channel and my very first attempt at a YouTube video. High school me would be shocked right now. Just a little bit about myself before we get started. I'm a chemical engineering student with a passion for finance, and like many of you, I got introduced to the world of trading and financial derivatives from the internet, just mindlessly browsing for resources. But I realized there's an overwhelming amount of resources online and they are somewhat scattered, so it makes it difficult to figure out the order in which you should learn these things, especially for an outsider like myself. So I had no one to reach out to, so I kind of just started out by cold messaging professionals in the industry or just Googling stuff, looking at it on YouTube. But hopefully with this channel, I can relay and condense some of that information and make it a bit easier for you guys. I can't stress enough that I am still far from an expert. I still spend time every day learning and I have lots to learn, but I finally kind of have everything mapped out and I figured out what I don't know and what I need to learn. But with that being said, let's dive right into today's topic of discussion, which is the incredible run that we've seen in GameStop this month. According to Google, GameStop is an American video game, consumer electronics, and gaming merchandise retailer. But that's all a fancy way of saying that they sell video games and gaming consoles. But its ticker on the New York Stock Exchange is GME. From a financial perspective, the company has suffered a lot in the past few years as brick and mortar stores continue to die out, and it was destined for bankruptcy with the way their profit margins have been decreasing in the past. And it's so far detached from the fundamentals, but it's gone up about 1,400% since September and as much as 300% in the last 7 trading days. That's almost 4 times your money in 7 days. Warren Buffett would be probably screaming right now somewhere. It had the most incredible short squeeze of the decade, orchestrated by amateur traders on a Reddit forum called WallStreetBets. These so-called traders bullied some of the biggest players that have been in the game for so long and likely cost them millions of dollars. But before we look into why it went up like that, let's rewind a little bit and go through some basic concepts that we need to know, such as shorting a stock, short squeeze, options, dealer positioning, and how all of these tied together to cause this run in GME. I'll try to explain this in layman terms, and I don't want to go into too much depth and make this an hour-long video, but if there's something unclear, drop a comment below and I'll try to clarify it there or consider making a separate video for it. Let's start off by understanding what short sellers are. In a stock market, you basically have 2 types of players, the bulls and the bears. Bulls are people who buy the stock because they believe it's going up. Bears are who believe that the stock is going down in the future, so they short the stock. Shorting means to borrow from someone else and sell it in the market. So essentially you're selling something that you don't own. When the stock does go down in price, you can buy it back for the cheaper price and return it to whoever you borrowed it from. Your profit is the money you get from selling it initially minus what it costs to buy it back. So this is opposite to what we've usually heard, So in this case, you want to sell high and you want to buy back low. By the way, you don't just go around to your friends and borrow stocks. Your broker is the one who facilitates this borrowing of stock. Short interest is the percentage of shares that were sold short divided by the total number of issued shares. A higher short interest number indicates that there's a pessimistic view about the stock, and it means a lot of people are betting that it will go down in the future. Now let's switch gears and move into options. Some of you might already know what options are, but just a brief intro. Options are highly leveraged products called financial derivatives because their price literally derives from a stock's price. There are 2 types of options, calls and puts, but let's worry about the calls for now. A call is basically a contract that allows you to purchase 100 shares of the underlying stock at a certain price during a fixed period of time. It's really simple concept, but in the interest of time, I'll let you search it up. What calls are on YouTube or Google if you want to learn more, because they'll do a better job explaining it using fancy visuals and whatnot. But just know that anyone who buys a call option on a stock will make money if the stock moves up a certain amount and in a certain time frame. So you're hoping that the stock goes up and it goes up quickly so that you make lots of money without injecting a lot of capital. But these are highly leveraged instruments, like I said, and it means you need just a small amount of money to make a large directional bet. But that also means that these are very risky instruments. It's very common to lose 100% of your investment compared to stocks, which is really extreme in that case. So now you're probably wondering who sells these contracts. This is where the market makers come in. Market makers do just that. They make a market for anyone looking to participate. A market maker can be a single trader or a large entity of traders, but they facilitate the buying and selling of stocks, options, etc., and they add liquidity to the market. They can play the role of matching the buyers and sellers, and if there's no sellers of a particular product, they'll become the sellers themselves. But it's important to note that unlike you and I, the market maker is not interested in the direction of the market. In fact, they don't want any exposure to which way the market is moving. They don't care if the market moves up or if it goes lower. So if I go to them and I want to, or I tell them if I want to buy a call option, which is a bullish position for me, they'll sell me that call and take the opposite end of the trade, which is a bearish position for themselves. But like I said, they don't care which way the market is going. They don't want a bullish or bearish position. So to hedge any exposure in the market movement, they're gonna buy the underlying stock. This means that if their options position starts to lose money, their stock position will make money by the same amount to offset any losses. They make money from selling the option at a slightly higher value than the theoretical price. Now, if you remember one of the most basic concepts of the stock market, you'll know that buying something continuously will lead to a higher price because of supply and demand. And likewise, selling something will lead to a lower price. So when the market maker buys the underlying to hedge its position, it's causing an increase in the price of the underlying, which is what a call buyer wants to see. It creates a feedback loop. Buying calls will lead to a higher underlying price, which attracts even more call buying, and so on and so forth. And usually some call buying on stocks is absolutely normal, but a big community on WallStreetBets started organizing others on the forum and decided that everyone was going to buy a lot of calls in an attempt to drive the price higher consciously. And this moved the price of the stock higher. Now this is where the short interest also comes into play and makes things a little bit more interesting and makes GameStop a special case. GME had a short interest of about 120%. It's changed a little bit. But yeah, it's possible to have a short interest of higher than 100%, but I won't go into that. All you need to know is that the fundamentals perspective, GME was considered a horrible business. In fact, it was expected to go bankrupt in the future. So a lot of people were short the stock, hence such a high short interest. Unfortunately for short sellers, when the stock moves higher, they stand to lose money and they get a margin call from their brokers to close out the position to avoid even bigger loss. So to close out their position, what they have to do is buy the stock back. Now, as we know, buying the stock leads to a higher price, and that created another feedback loop. The higher the stock went, the more short sellers had to close out their position, driving the price even higher. And this phenomena of reflexivity resulting from excessive call buying and shorts having to cover their position is what moved it over 1400% in such a short period of time. And I know it sounds like a very bizarre concept, but this is what happens in a short squeeze. So that's it for my very first video on YouTube describing what a short squeeze looks like. Hopefully you guys learned something new and took away some value out of this. And I know I didn't explain everything in depth, but I could talk about this stuff for hours and anything finance related really. So comment below what you would like to see and I'll get started on that. And hopefully my editing skills will also get better in the future so I can drop some visually appealing videos for y'all. But for now, thank you for watching. Hit the subscribe button and stay tuned for the next video. Thank you.